I will delete this file in 20 minutes, not because I'm afraid, but because it won't be needed anymore. Everything inside it has already happened. Last night, while you were sleeping, a sentence appeared in legal language that turns your money into raw material. Not risk, not an asset. Raw material. At 4:12 a.m., a terminal I still have access to froze for 3 seconds. Exactly 3. On a trading floor, that's always a bad sign. Not shouting, not panic. Silence. The kind where people stop moving because their brains are trying to understand what just broke. I remember that sound, or rather, its absence. Like someone removed the air. The document didn't arrive as news, it arrived as an update. Dry, no commentary, buried inside a bundle of legal amendments where commas and cross-references usually change. Internal file number 404B. The irony would be funny if it weren't so precise. Page after page, gray font, standard phrasing. And then the paragraph I reread 4 times. Not because I didn't understand it, but because I understood it too well. In the event of systemic instability, a bank's obligations to depositors may be converted into instruments of equity participation. In plain terms, when the bank is in trouble, your money stops being yours. It becomes theirs. I've seen hands shake when markets crash. I've seen traders pass out when a billion-dollar margin call hits. But this was different. There was no movement. There was realization. Cold, slow, like water rising in a hull. You know you're sinking long before the water touches your face. I leaned back in my chair and stared at the ceiling. The fluorescent light flickered at the same rhythm as my pulse. It always does when you realize you weren't deceived as a customer, but reclassified as an object. You need to understand the mechanics. Not slogans, not emotions. Mechanics. A bank is not a vault. It's a balance sheet. Assets on the left, liabilities on the right. Your deposit is a liability, a promise to repay you. As long as everything is fine, that promise looks like money, like numbers in an app. But under stress, the balance sheet has to balance. And when assets fall faster than liabilities, a hole opens up. In the past, that hole was filled with taxpayer money. Politically, that became toxic. So they found another solution. Turn liabilities into capital. Force you to become a shareholder at the exact moment the shares are worth nothing. This is not rescue. It's loss redistribution. From you, onto you. At 6:15 a.m. on the 42nd floor, there was a meeting. No minutes, no coffee. People stood by the window because it's easier to think about unpleasant things when you're looking down. One of the lawyers said a sentence I remember word for word. This is not confiscation, it's conversion. He smiled like someone who knows words matter more than meaning. That's when I understood the game had fully changed, because when someone explains why something is legal, it means it's already done. The cynical math is simple. The average regional bank has an equity to liability ratio of about 8%. That means a 10% drop in asset value makes the bank technically dead. But instead of death, there is now transformation. Take deposits, not all of them. First the uninsured portion, then, if necessary, the rest. Swap them for shares. The balance sheet balances. The bank lives. You don't. On your screen, instead of a dollar amount, you see a number of shares. The illusion is preserved. The money is gone. I ran the numbers on the back of an envelope, not because it's complex, but because it's terrifying. If you had 100,000 and the bank converts 20% of liabilities, you instantly lose 20,000. But that's just the beginning, because the shares you receive are illiquid. You can't sell them. Their price collapses because the market knows they weren't bought voluntarily, but imposed. A month later, those shares trade at 5% of nominal value. Your real loss is 95% of the converted amount. This is not a crisis. This is design. The most dangerous part is the loop. Once depositors start to understand this, they try to withdraw funds. Banks see liquidity outflows and tighten conditions. Transfers are delayed. Limits appear. That fuels panic. Asset prices fall faster. And then comes the moment the clause was written for. A legal switch. Click. Liabilities become capital, and capital cannot be withdrawn. You are no longer a depositor. You are a participant. I've seen the log files. I've watched liquidity monitoring algorithms turn yellow, then red. The error code was simple. LQ17, insufficient high-quality liquid assets. Normally that's followed by an emergency credit line. This time, the line stayed silent. Because it's no longer needed. Now there is you. Your money, your savings, your trust, wrapped in legal language. And this is the part that must be said out loud. This is not an emergency measure. Not a plan for the apocalypse. It's a built-in mechanism. Quiet, legal. Triggered not when television screams, but when the screen goes silent. Its purpose is not to save the system. Its purpose is to preserve the appearance of functionality by shifting losses onto those who don't have access to the 42nd floor. You might ask, why now? Because the cycle is at the edge, because yields are distorted, assets are overvalued, and trust is the last remaining resource. And they decided to monetize it, once, then again, until you accept the idea that money in a bank is not your property, but a conditional claim that can be rewritten. I'm sitting in an empty office right now. The air conditioning is too loud because nobody adjusted it overnight. A cursor blinks on the screen. I know this will sound like conspiracy to many people. Truth always does, before it becomes an instruction manual. But I'm no longer inside, and I have nothing left to lose except the obligation to say this out loud. Because when legal language starts using conversion instead of theft, theft has already become normalized. If you think this only applies to large balances, you're wrong. Thresholds move, definitions expand, exceptions disappear. The system learns from every crisis and becomes colder, not angrier, colder. And that is what should scare you. Not shouting, not charts, but the silence in which your money changes form without your consent. I'm not asking you to believe me. I'm asking you to watch the wording, the updates, the way deposit and ownership begin to drift apart. Because when you finally notice, there will be very little time left to react. Very little. And that's why I'll delete this file. Because what comes next is worse. And that's no longer speculation, but the logical outcome of a system I've seen from the inside. And here the road splits into 3 paths, and all of them lead downward. Not with drama, not with sirens. With paperwork, latency, and decisions made before the public understands the question. The future doesn't arrive as a headline. It arrives as a delay. A delay in settlement. A delay in withdrawals. A delay in truth. I've seen it enough times to know the smell of it. Warm electronics, recycled air, people speaking more quietly than usual because loud voices feel inappropriate when gravity is increasing. There is a version of the future they will sell you first. The version with careful smiles and rehearsed confidence. In that version, the system absorbs the shock. A few banks wobble, merge, disappear behind friendly press releases. Depositors are reassured. The clause exists, yes, but it's described as a seatbelt you'll never need. Markets stabilize, volatility compresses. The talking heads explain that lessons were learned, safeguards improved, stress tests updated. In that version, nothing is taken, nothing is converted. Trust survives, bruised but intact. People nod and move on because they want to, because believing costs less energy than resisting. But that version only works if the pressure releases, if asset prices gently deflate instead of snapping, if yields behave, if confidence returns before liquidity leaves. And confidence is the most fragile variable in finance, because it cannot be forced. You can print money, you can write laws, you cannot order people to believe while changing the rules mid-game. The optimistic path depends on timing so precise it borders on fantasy. It requires millions of independent actors to remain calm while the architecture beneath them is quietly rewired. I've never seen that happen. So the road bends, almost without you noticing, into the version that actually fits the math. Not catastrophe, not collapse. Attrition. A world where nothing breaks all at once, but everything works a little worse each week. Yields creep up in places most people don't watch. Funding costs rise in corners that don't make the news. Banks tighten policies quietly. Transfers take longer. Customer service scripts get longer too, filled with apologies that explain nothing. The clause remains unused, officially dormant, but its presence changes behavior. Risk managers model it. Lawyers reference it. Executives sleep better knowing it's there. Depositors don't see it, but they feel it, like a draft in a closed room. In this version, the conversion doesn't arrive with a bang. It arrives selectively. One institution first, framed as unique, mismanaged, an exception. Uninsured deposits are restructured. The word spreads, but slowly enough to be dismissed as anecdote. Some people get their money out, others can't. Most don't try, because trying is an admission that something is wrong, and humans resist that longer than logic would suggest. Markets grind lower, not enough to trigger alarms, just enough to keep pressure constant. This is where the system prefers to live, not in crisis, and manage discomfort. And then there's the third path, the one nobody advertises, but everybody inside models. This one doesn't start with banks. It starts with bonds, with an auction that goes poorly, with a bid-to-cover ratio that makes desks go quiet, with yields that gap higher not because of inflation, but because of doubt. When sovereign debt stops behaving like a risk-free asset, everything priced off it starts to float. Balance sheets lose their anchor. Collateral values drop. Margin calls ripple outward. Liquidity evaporates in places that were supposed to be deep. This is when the clause stops being theoretical. In that future, the conversion happens fast because it has to. Overnight decisions, emergency meetings, legal memos sent before dawn, transfers frozen under the language of temporary stability measures. By the time most depositors realize access is restricted, the switch has already been thrown. Numbers on screens change form. Statements update. The money doesn't vanish theatrically. It just isn't withdrawable anymore. You are informed politely that you now hold an interest, participation, equity. Words that sound constructive until you try to pay rent with them. If you want to know which road you're on, don't watch the news. Watch the things that don't get panel discussions. Watch long-term bond yields relative to short-term ones, not for inversion headlines, but for volatility. Stability is more important than direction. Watch bank funding spreads, the quiet widening that signals distrust between institutions. Watch deposit growth, not totals, but velocity. When growth stalls while incentives increase, something is wrong. Watch physical inventories where paper claims dominate. When delivery times stretch and premiums detach from spot prices, the system is telling you it no longer trusts its own abstractions. And watch behavior, not of consumers, of insiders. Executives who sell stock while telling you everything is fine. Funds that increase cash quietly without announcing defensiveness. Regulations proposed as modernization that expand discretion during emergencies. You don't need secret data. You need to stop looking where they want you to look. News is narrative. Signals are mechanical. So what do? Standing at this intersection, knowing all roads slope downward. You don't panic. Panic is expensive and usually late. You don't try to outsmart the system. It was built by people with more time and leverage than you. You simplify. You reduce dependencies. You ask one brutal question repeatedly. Can this be converted, frozen, delayed, or redefined by someone else? Physical assets matter here not because they go up in price, but because they exit the ledger. Physical gold isn't a trade. It's a removal. It doesn't yield. It doesn't perform. It sits outside the system that needs your participation to function. Cash matters not because it's safe forever, but because it buys time. Time to decide. Time to move. Time to say no when a screen tells you yes is mandatory. Diversification across institutions isn't paranoia. It's acknowledgement that concentration only works when rules are stable. This isn't about hiding. It's about optionality. About keeping at least part of your life beyond the reach of a late-night legal update. About understanding that convenience is a trade and the price is often invisible until collection. You don't need to abandon banks. You need to stop treating them as neutral custodians. They are counterparties, and counterparties change terms when they're stressed. The hardest part isn't the mechanics, it's the acceptance. Accepting that legality and morality diverge under pressure. That something can be lawful and still be extraction. That the promise you grew up with, that deposits are sacred, was conditional all along. The clause didn't create that reality, it revealed it. In the end, this isn't a story about money, it's a story about consent, about when you are allowed to say no and what happens when you do. Systems like compliance, because compliance is predictable. Refusal is expensive to manage. That's why it's discouraged, delayed, and reframed as irresponsibility. But there is a point where participation becomes endorsement, and endorsement becomes complicity. You don't get to choose the architecture you were born into, but you do get to choose how much of yourself you embed inside it. The future won't ask for permission. It will present you with outcomes and call them options. Your responsibility is to recognize the difference. There is a right that exists before any statute and survives after any clause. The right to withdraw, the right to opt out, the right to say no when the cost of yes becomes unbearable. Exercising that right isn't loud. It doesn't trend. It happens quietly in decisions that look boring from the outside and feel heavy from the inside. If you leave this conversation unsettled, that's appropriate. Comfort was never the goal. Awareness carries weight. Once you see the slope, you can't pretend it's flat. And once you understand that the rules can change while you sleep, the burden shifts to you. Not to predict the future perfectly, but to stop outsourcing responsibility for it. That's the horizon, not fire, not collapse. Responsibility. And it's heavier than most people expect.